Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonal Bhutra. It's an out-and-out auto day. It's pulling the markets down. The benchmark indices are nearly down 1%. The Nifty Auto Index is down 3%. For this week, it's a 5% fall, and the cuts are brutal. Look at a Bajaj Auto. That's down close to about 10%. But you know, it's not just auto, right?
Yeah.
Like at the index level, maybe you can say, well, the top 5 losers are auto. But look at the way the mid-cap index has come under pressure. The mid-cap index is down 1.25%. The advanced decline ratio is under pressure. Banks, which were showing signs of outperformance, have now, are under pressure.
Yeah.
So that's also weak.
And you know, the indications for what was going to happen in the auto index maybe were there because we've been talking about auto index every day this week.
Yeah.
That, you know, that is the top loser today. And Bajaj Auto's numbers and most importantly, commentary is something which has spooked the street in terms of what the two-wheeler stocks are doing today. So as Reema mentioned, the top 5 losers are from the auto space. We do have the likes of Bajaj Auto, Hero MotoCorp, M&M, Maruti Suzuki, all of them under pressure. If we talk about sectoral movers today, it's Nifty IT. That is the sole index in the green today. We do have a lot of earnings which will come in today. We are reacting to a lot of earnings that came yesterday. So Nifty IT, though it has come up from the highs, is the one which is supporting markets a little bit. But a very stock-specific market. Mid-caps, again, have reversed the gains that we've been talking about. It's a 1% cut there. And we do have other names like the Realty Index, which is under pressure. We have the private banking space, which is under pressure. So yes, it's an all-round downtick that we are seeing, despite the fact that the handover from the Wall Street was strong. But the big story, of course, is Bajaj Auto. It's fallen sharply today. In fact, it's now an almost 10% cut that we're seeing on Bajaj Auto. Yes, there you go, almost 11%. This is on cautious management commentary post Q2 results. Sudarshan is joining in with all the details. Sudarshan, weak numbers, weak commentary most importantly.
That's true. So Bajaj Auto had reported earnings that were largely in line, but commentary was cautious. On the back of that, we are seeing a major fall for majority of the auto stocks. Even in the last few weeks, like ahead of the earnings, we have been seeing that all the auto companies were falling. The auto index is down 9% from the record high that it hit on September 27, and all the constituents are down this month and up to this week. So, for example, Bajaj Auto is now down almost 13% for this week, followed by Hero MotoCorp, Maruti, M&M, TVS, all these stocks have been down. So what are the reasons for the recent fall? First, festive demand in the first half of the festive season has been below expectations. Retail registrations show muted demand in the first half, and it's confirmed by Bajaj Auto. Talking to CNBC-TV18 today, company has said two-wheeler industry growth in the first half of the festive season was in the range of 1 to 2% against companies' expectations of 5 to 6% growth and against brokerages' expectations of almost 8 to 10% in the festive season. And another concern, if I can point out, is the concerns related to inventory buildup that most of the brokerages had pointed out ahead of the Q2 earnings. Third is raw material costs continue to increase, and that can be seen in Bajaj Auto's earnings as well. Raw material cost had impacted margin to an extent. Next is Hyundai IPO demand has been muted so far. Till yesterday, total subscription was just 0.43 times, that is 43%. And last is there is no valuation comfort. In the last 1 to 2 years that all these auto companies, the kind of rise that these companies have seen, there is no major valuation comfort. For example, Bajaj Auto's FY26 PE is 28 times against 5-year average of 20 times, M&M 26 times against 5-year average of 17 times, Hero Moto 20 times against 5-year average of 18 times, and similarly for Maruti and TVS Motor. So these are some of the major reasons that because of that auto companies have been falling in the recent last few weeks.
Thank you very much for that. You know, in the UBS note where they're talking about, like even Bajaj Auto said, right, they're losing market share in the sub 100, 150cc category where the demand has been weak. So the UBS note says that competitors are ordering record discounts of 7 to 11% ex-showroom prices in that low, end category. So that's also, I mean, that's the kind of, discounts you have to give to entice customers, and yet demand is on the weaker side.
And it's an 11% cut on a Nifty stock. Yeah.
But it's also a stock which I think prior to the up move had gone up close to about 70%. So there is that big outperformance for Bajaj Auto. But earlier today, we did chat with Rakesh Sharma, Executive Director, Bajaj Auto, post their Q2 performance. Listen in to some of the key excerpts.
This is the fourth successive quarter of delivering 20% plus EBITDA margin. And what is noteworthy is that this is despite the fact that the electric two-wheeler portfolio has increased substantially. In fact, the electric portfolio of Bajaj Auto is now over 20% of the domestic revenues. And if I may add the green portfolio, the greener fuels portfolio is almost 44% of Bajaj Auto's domestic revenues. The 20% plus margin has to be viewed in the context of the substantially growing electric two-wheeler portfolio, which we are very, very happy about. I would say that the first half of the festive has been slightly below expectations. There is growth, but very marginal growth in the industry. The 100cc bottom half segment is, as per Vahan registrations, negative, and the 125cc plus segment is positive. But put together, the industry is at 1 to 2% growth in the first 15-16 days of the festive.
All right, that's the commentary coming in from Bajaj Auto. The other stock in focus is Nalco. The shares are surging in trade today. Nigel is here to explain what's happening here. Nigel?
Well, that's right. Nalco is outperforming in today's trading session, not just the market, but even its own metal index. A few factors have played out. One is Chinese have announced various measures this morning. There's a split verdict whether or not it was enough, so we'll keep that aside. But the bigger trigger was that Alcoa came out with its set of numbers overnight. And in aftermarket hours, the stock was up close to around 6%. A few important factors that played out here. One is the quarterly numbers were the best that we've seen in the last few years. The EPS estimates that Alcoa delivered, well, it was much better than what the street was working with out there. And the reasons they have stated for the big beat is that alumina prices were better, and they have also gone on to state that costs were lower. Now, the read-through with regard to alumina prices is very, very positive for Nalco because it's a direct beneficiary. They are selling alumina in the open market. Remember, we had the management who joined here on CNBC-TV18 itself earlier this month, and Mr. Patra said that they're expecting alumina production to ramp up from next year onwards. To give you a number, they said this year they'll do 2.1 million tons, next year 2.6, and following that will be more than 3 million tons. That's on the volume aspect. But on the pricing aspect, he was very, very positive. He said that he expects alumina prices to hold at around $600 per ton, which is much higher than what Street is estimating. And also now Alcoa is saying that the global market is going to be in a deficit. Putting this together, the direct play on higher alumina prices is Nalco, and that's why that's seeing a good amount of buying in today's session. Back to you.
Thank you very much for that. Why are you watching city gas distribution companies?
Well, you know, these stocks have been down 5%, all of them in this week itself. Okay. And there have been a lot of chatter around cut in APM gas allocation. And now sources are suggesting that, yes, this has come by and it's a big cut that has come by as well. So what this means is that domestic gas which is produced is given to city gas distribution companies, which they process and convert into CNG. Usually they would get the priority and most of the APM gas. But this time around, it has been cut to near 50% versus 72% of the gas that they were getting earlier. This would mean that they will have to purchase imported gas at higher price, and that's the reason this pressure on city gas distribution companies that we've been seeing. So some of the alerts is this was applicable from 16th October, and GAIL had sent out communication to city gas distribution companies. It did not come from the ministry directly, but the private players, they went ahead and spoke to the government yesterday, is what the sources are suggesting, to increase the allocation, but it is because it has been cut down sharply. Now, this would be one of the biggest cuts that we have seen in a long time for APM gas allocation. And now, remember, APM allocation at the start of the year, it was around 85%. And if it comes down to 50%, this will be one of the biggest cuts in allocation that we would have seen. What would the impact be? Now, it would impact the margins by around 1.8 to 2.3 rupees per SCM for all the three city gas distribution companies. And this would mean that they will need to go ahead and increase prices by 5 to 6 rupees per kg on CNG in whichever geography they are. However, I spoke to some analysts and they are of the view that because of the upcoming assembly elections, their ability to increase prices for CNG would be limited. And if they are not able to do that, they will have to take a hit on margins. And the fear of margin pressure is something that the street is worried about, because right now imported LNG prices around $11 per MMBTU, while domestic gas is around $6.50. So there's this big delta which these companies need to deal with, and that's why this cut that we are seeing on the stock prices.
Okay, so at least as of now, it's not going to hurt consumers in terms of a higher increase in, an increase in CNG prices, perhaps on account of election. But once that's out of the way, it also means higher prices for us. So inflation also on the uptick. But Kolte-Patil, that's also on the move. Big move, actually.
Yeah, in a weak market, Kolte-Patil is doing really well. And this is because of a good Q2 update. It's an improvement both on a sequential and on a YOY basis. So volumes, they are up 5% on a YOY basis, up 7% sequentially, more than 1 million square feet. Sales value is up 22% as well. It has gone up by 8% on a sequential basis, and collections are up 16% on a YOY basis, though they have come off on a sequential basis by 10% at 550 crore rupees. First half has been decent because they've been able to increase their volumes by 4%. The sales value has gone up by 11% to come in at around that 1500 crore mark. Now remember, the company had earlier indicated that they will be able to do 3500 crore rupees of sales in FY25. Looks like majority of it will come in the second half because they've just done 1500 crores in the first half. So second half would need around 2000 crore rupees. They're confident, they have launches lined up, and the confidence is something that the street seems to like. So 10% higher on Kolte-Patil today.
Thank you. That wraps up our list of buzzing stocks, at least for 11 o'clock. We'll slip into a break. We'll come back and discuss commodities. Manisha Gupta joins in on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour. It's time to talk about the commodity space. We've seen the downtick in equity markets, but what's happening in the commodities space? Manisha Gupta is joining in now. And what are you focusing on today, Manisha?
Thank you for that, Sonal. I'm looking at metals as a sector. We started the day on a positive note, but that's not how we are going about it right now. One is the strength in dollar index, which is trading at an 11-week highs yet again, which seems to be putting pressure across sector right now. And second is the China property cues, which continue to be quite underwhelming. It was supposed to be a very strong briefing with various departments, ministries and regulators coming in today, but that hasn't really given much to the markets to gain up from here. What we did hear from the China housing minister was that they will take monetization measures for urbanization projects. There also was a promise to add 1 million village urbanization projects therein, also to expand whitelist of projects, bank lending to almost 4 trillion yuan as well. So these were 4 or 5 things that we heard from the briefing. But then again, there were lack of any new features. These are something that the street has been already discounting and talking about. Second, there was scant details on implementation of all of these projects. Third was that there was any absence of any bumper measurements, something that the industry has been hoping for last many months now. So that is what led to an immediate profit taking across metals. So whether it was about copper, steel, aluminum, zinc, all these metals are trading into the negative right now. We started almost half to 1% on the higher side early Asia, expecting something strong to come in. But what the street will watch out for now is the European Central Bank monetary policy meeting today. There is an expectation of another rate cut coming in from that. And then tomorrow you have the Chinese third quarter GDP numbers coming in as well. So between these two events and data is where the markets will be taking cues from.
Thank you very much for that. We'll get into a break. We'll come back, discuss market technicals. Nagaraj Shetty of HDFC Securities joins in with his top trading bets. Welcome back. So today is a big IT day in terms of earnings. You've got 3 nifty large cap IT companies reporting numbers: Infosys, Wipro, LTIMindtree. It's just that all 3 of them report their numbers post-market hours. So I just want to quickly run you through what the street is anticipating. Let's start with the big boy, Infosys. Now here, just quick 3 things about each of these 3 companies. About Infosys, expect a very strong revenue growth ahead of peers. So dollar revenue growth, 3.6%, constant currency revenue growth at 3%. And this 3% is better than what peers have reported, like a TCS, which was about 1.1%, and HCL Tech at 1.6%. Now, the question is, will this drive a guidance upgrade And analysts believe yes. So Kotak, Citi, Morgan Stanley, they're all expecting the company will raise the current revenue guidance from 3 to 4% and they will up it. Now, since June, though, Infy has outperformed its peers, having rallied close to about 40%. So the street is expecting good numbers, and that's what's already been priced in. Now, when it comes to Wipro, for starters, expect a flat revenue growth. Revenue growth for the company has been negative for the last 6 consecutive quarters. This time, according to the CNBC-TV18 poll, expect a 0.1% revenue growth, so very flat. The key will be next quarter's guidance, which is seen at minus 0.5 to 1.5%. And also remember, this time Wipro will be considering a bonus, its first bonus issue since 2019 and the first one under the new CEO. For LTIMindtree, again, the street is optimistic because 35% of its revenues come in from the BFSI sector. And we know the BFSI sector is doing well. It's showing signs of recovery and growth and momentum. So expect about a 2.7% revenue growth this quarter. And even in the prior quarter, led by BFSI, growth was quite strong. Margin expansion is likely to continue for the second consecutive quarter. 15.5% is the CNBC-TV18 poll. But, LTIMindtree struggled last year. Till then, they were always in the top quartile, they used to call it, in terms of revenues, in terms of, profitability, etc., growth, in terms of growth metrics. And last quarter, they struggled because of BFSI. So now, now the BFSI is again picking up. How do they get back to, with the top quartile, industry-leading kind of growth? That's something the street will watch.
Okay, these are important numbers and a busy day for you yet again. We've been saying it for the last couple of days. Thank you for that, Rima. But with that, let's move on now. Nagraj Shetty from HDFC Securities is joining for a quick technical check on the markets. Nagraj, good morning. Thank you so much for joining in. If you can tell us what are the next levels to watch out for on the Nifty and your individual trading bets as well.
Hi, good morning. Nifty has been in a range-bound action over the last 5-7 sessions. We have seen market made an attempt to move up from lower levels at the 25,200, 25,100 has been a strong resistance. Market was not able to show a sustainable upside bounce, and today it has given up. I think there is a support, immediate support is around 24,700 level, which looks like is going to be break below that 24,700. I'm not expecting a bigger decline below 24,700 at the lower levels. 24,500 is going to be a good support for the market as per the smaller as well as larger time frame charts. So from the lower levels, there is a higher possibility of upside bounce in the Nifty from somewhere around 24,500 odd levels. So I have a mix bets in terms of stock picks, and one is from a long and one is from a short. But let's discuss on a long side. Chennai Petro has been in a range-bound action quite a while, and in the last 2 sessions, it made an attempt of upside breakout of the range, looking positive, outperforming during the volatile broader market and benchmark Nifty. And currently trading around 958, 959. One can look to buy around these levels. 1020 is going to be the target, and 920 is going to be the stop loss for this call. And second one is BHEL. BHEL has been in a continuous underperformance. We have seen some lower bottom formations for the stock price. Currently placed around the support of 200 EMA, which is a crucial support, but not showing any sustainable bounce from the support. Currently placed at the support. Now it's at 258, 259. One can look to sell BHEL at this point of time. The target would be around 248, 246, and 264 is going to be the stop loss for the short.
Okay, all right. Thank you so much for joining in. That is a technical check on the markets. With that, we'll do one thing. We'll slip into a short break. Up next, we'll discuss the fundamentals of the market and the way forward with Santosh Singh of Motilal Oswal Asset Management. Stay tuned. Welcome back. You're still tuned into Trading Hour on CNBC TV18. Well, let's talk about an exclusive conversation now. In a conversation with CNBC TV18's Shireen Bhan, Zerodha's Chief Technical Officer Kailash Nath shares his opinion on the hype around artificial intelligence. Listen into that interesting conversation.
Let's talk about the future in the context of what everybody is talking about, AI. So let's get down to it. And I'll start with you because I know that you believe, and I think I tend to agree with you, that some of it has been misguided assumptions about what it could potentially do or how soon or, whatever. Some of it you also believe is plain intellectual dishonesty in the claims that are being made by many. And I'm not talking in the Indian context, but in general at this point in time. I mean, everyone is AI's expertise at your fingertips or, AI first and so on and so forth. Today, as you look at your business, as well as you look at the adjacent ecosystem, what do you make of this?
There is insane amounts of hype. And the moment there are financial incentives attached to anything, AI was an academic dream 60, 70, 80 years ago, and it's evolved into business today. And there is absolutely insane amounts of hype, not just India, globally. But beneath the hype lies legit breakthroughs that have happened in the last 2-3 years. These large language models that all of us use in some form or the other daily now, these breakthroughs have come in the last 2-3 years. And these breakthroughs are legit. Doesn't mean that everything that is said out there is legit. So between the hype, froth and frenzy, legitimate use cases. And at Zerodha, we've started to use some of these things to solve internal problems. Something that a lot of tedium that 100 people were dealing with. We have one small little open source AI system running on one server.
You're the big open source guy, right? The big believer. Only open source, yeah.
So this one system that costs us nothing to run is saving 100 people thousands and thousands of hours of work every month. And it's an open source breakthrough. It's commoditized. Now you can have the most powerful AI models, let's say large language models, at your fingertips at zero cost. You just need to have that tech know-how to use it. So it's been commoditized to such a large extent. When anybody says we are powered by AI, you have to take it with a giant sack of salt because an 18-year-old teenager,
how giant?
Big, an 18-year-old teenager who's tech savvy can start using these things. You can build a business out of it, tool out of it in no time. So it's commoditized to death already. And it's only been 3 years in the specific set of breakthroughs.
And you can catch that fun and full interview on our special Young Turks Reloaded today at 7 p.m. Stay tuned for that. By the way, Hyundai's IPO update is coming through. As of 11:25, which is about less than 10 minutes ago, the total subscription stood at 51%. At the day's close yesterday, day 2, it was 45%. So in the morning, it's moved up from 45 to 51%. Retail is 42%. QIB is 80%. NII stands at nearly 30%. But these things tend to pick up, closer towards the end of the trading session. Get into a break. We'll come back with more on the market. Stay tuned. Welcome back. Let's talk markets. Santosh Singh from Motilal Oswal Asset Management is now with us on the show. Santosh, thank you very much for joining in. This is Reema here. I was just taking a look at your large cap fund or even your focused fund. While you do have some auto ancillaries, these large auto companies are missing, whether it's two-wheelers, passenger vehicle makers, or even tractor makers. So is it that you've always been negative on autos? Has that view changed? And your thoughts on Bajaj Auto and what's been reported?
So one of the reasons, it's not that we are perpetually bearish on autos. We like autos a lot. There was a time when we used to have quite a bit of autos. But the reason why we don't have it in our portfolio is, the biggest reason is that we are seeing a big slowdown happening in the auto PV and two-wheeler segment as well. We are seeing sort of demand not being there. And the valuations per se are not cheap. So if the demand scenario is weak and the valuations are not cheap, then there are chances that you might not make good money out there. So that's why we don't have much of auto as of now.
How long do you think this weakness is likely to last? And since when have you been bearish? Because Bajaj Auto, for instance, did really well as a stock price till very recently.
Yeah. So that was, I would say that we missed that, but we had auto comps which did equally well. So we are happy with that. Some of the auto comps which we had did equally well. But at the same time, see, most of the other players, if you're looking, so this view is for last 1 year. Before that, we used to have a lot of other stocks as well. Right, so it's for last 1 year we have that view that on the OEM side, if you really want to be, and even if you are bullish on autos, we should be rather be on the OEM side, the autocom side rather than the sort of OEM side, because if there is an uptrend that is visible even in the autocom. But the sort of autocoms we are holding are not only dependent on India auto sort of demand scenario. It's also, so we have a large amount of Samvardhana, which is global, acquisitive and all. We have a good quantity of ZF, which is a sort of a global leader in what they do. So we are not sort of just, so given the demand scenario, we were not bullish on OEM. So we wanted to sort of cap it with the autocoms.
Santosh, a lot of these global OEMs also sounded off some warnings in terms of profits, and that is something that could have impacted some of these auto ancillary companies. You mentioned Samvardhana, Motherson, which has international exposure. Do you think that could be a cause of worry if these OEMs also start talking about demand pressures, and that could ultimately mean something for these auto anchs as well?
So if you were sort of only looking at the demand scenario, we would have been in those sort of stocks. So if I'm looking at Samvardhana, it's not only about global auto demand, it's also about the acquisitions which they do. And in bad times, they tend to do really well, because in bad times, they tend to get some good assets at good prices. So that is one call we have taken. Second is the reason we hold sort of Samvardhana is it's also a EMS play, right? It's becoming sort of a manufacturing play in India as well, given their focus on and then the new sort of tie-ups which they have done. So that was basic reason why we are in that sort of auto comps. We are not into all auto comps. We are in those sort of auto comps which are not only dependent on auto demand, which are sort of innovators themselves, which are on the right side of the technology. So not really worried about a few of our companies which we hold.
Just seeing the IT, composition in your large cap fund. About a month back, you had Infosys, Tech Mahindra, and an LTI Mindtree. Now it appears Tech Mahindra is out and it's replaced by TCS. Is that correct?
It seems like so. I'll not get into individual stocks, actually. I can talk about the broader call which we have. Don't want to get into individual stocks. See, the broader call which we have is if there is a rate cut, we are going to see sort of the large cap IT doing well. But at the same time, if certain stocks have moved up and then there is a valuation discomfort, we would want to sort of come out of that as well.
The other space that did well yesterday was HDFC Life, the insurance space, so to say. You do have some stake here. How are you looking at these insurance companies? What do you like in the space currently?
So if I'm looking at the insurance companies, simply they have not done well for last 3 years. Whereas it's not that sort of these companies have not grown their profits. If you look at the profit CAGR, it is somewhere between 17 to 18%. But if you look at the stock price CAGR, it's either negative or zero. So if in that scenario, financials is the only space you can say that which is trading at lower than its long-term average multiples in a market which seems to be either at or higher than the long-term average multiples. So we like that space, and specifically the biggest area we like, which is not working as of now, is the sort of health insurance space, which I really like. Given the sort of growth we are looking at, 20-22% growth rate in profitability, and the stock's not doing anything. Now, a lot of stocks have gone down to sort of, so something like a Star, which you're showing as this on a trailing basis, it is down to around 35, 37 times earnings. And that also on cash earnings. On IFRS, it is down to around less than 30 times earnings. So really a space where a 20% sort of growth in profitability and 30 times or less than 30 times earnings seems quite comfortable for us.
I remember our last conversation where you were talking about Religare, and you said one of the reasons why you like Religare is because it owns Care Health Insurance, which is doing very well and seeing some good, growth rates. But thank you very much, Santosh, for joining in. It's a busy day in terms of, lots of earnings and news to track. So we're going to leave the conversation here for now. We will slip into a short break on that note. On the other side, we'll get chatting with the management of South Indian Bank on their Q2 numbers. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Well, South Indian Bank's Q2 net interest income grew by 7% YOY, but the bank's net interest margin declined both on a sequential and on a YOY basis. To discuss the Q2 numbers, the outlook for deposits and slippages, we are now joined by PR Seshadri, the MD of the bank, joining in now. Mr. Seshadri, good morning. Thank you so much for joining in. Well, you've seen a small dip in NIMs this quarter, but this is along with an increase in your credit deposit ratio. Can you give us a sense of how they are trending in the second half? What's the outlook on net interest margins and the CD ratio?
Thank you very much for having me on the show. With respect to net interest margin, we actually didn't see too much of a dip. Basically, what happened was RBI changed the method by which penal interest was actually charged. So up until the last quarter, penal interest was a portion of interest revenue, and this quarter, the reported quarter, it was charged as a penal charge and therefore went into other income. So if you were to add that back, you would find that there's no material change in net interest margin. With respect to our CD ratio, our stated strategy was to grow our deposits at between 8 and 10%, and that enables us to keep the cost advantage that we currently have on interest costs, and at the same time grow our assets between 10 and 12%. So we were aware of the fact that CD ratios would grow gradually. Now we've hit about approximately 80%. And at this point in time, we are reevaluating, what we should be doing and whether we need to double down and try and get, a little bit more aggressive on the deposit side.
But as of now, your goal is 8 to 10% in terms of deposit growth, but you could look to become a little more aggressive. At least match maybe the asset growth of 10 to 12%?
Yes.
Do you think that's likely? Okay.
That's
so
true,
within So within your advances growth and your guidance, in Q2 per se, home loans is done very well for you with a growth of, I think, close to about 40%. Gold loan has seen a growth of close to about 10 to 11%. Can you tell us your expectations segment by segment for FY25 and even the second half of the year? Where is growth momentum being seen?
Majority of the growth will come on the retail side, retail and MSME. MSME continues to stay muted. So our focus is on the secured side. So, gold and housing continues to be areas of, interest. So we think that there we will continue to see the kind of growths that we've seen so far. It will moderate a little. It's hard to be at 45%, growth continually. But having said that, the structure of the balance sheet will alter. Currently, approximately 40% of the balance sheet is corporate. That we think, in the medium term will come down to about a third. So, and the slack would get taken up by retail and MSME.
You spoke about how your focus is, of course, the secured part of the portfolio, and your credit costs, they have remained mostly steady. But there has, of course, been a lot of focus by the RBI on secured lending. I just want to understand how much portion of your portfolio comes in from unsecured lending. Will there be any increase in credit costs in any of the segments going forward?
So unsecured, you get unsecured in two forms, unsecured to the large corporates and unsecured to retail. Unsecured to retail is roughly 5% of our total balance sheet. And that's where the, commentary on, issues that one is seeing is coming to us. That is very, very contained, and we are not looking to grow that very aggressively. On the unsecured to corporate, given the fact that corporates have changed the balance sheet and improved the structure of their balance sheets, we see no particular risk at this point in time. We do have reasonable exposure unsecured to corporates, and we are monitoring that very closely.
Just getting back to that question on CD ratio. So I think currently it's about 78%. By the end of FY25, where do you think that, that number could be? Could we get closer to 75%?
We probably will stay in the same range, 77, 78. If you get too close to, 75, then there are significant costs associated with it. So we want to remain very liquid. Our LCR ratios are very comfortable. We are well north of 100%, which is what the RBI wants. But having said that, at the same time, we want to, have CD ratios which are closer to 78, 79, 80%. and not get too close to 75 because of the costs associated therewith.
And one final question, if you could give some color on the asset quality, how slippages are likely to trend, your NPAs in the second half of the year, any trends that you would like to highlight?
So for the quarter, we came in at about 36 basis points. That is just for the quarter, non-annualized. We think we should remain at these kind of levels. We may, there will be a 5, maybe 10 basis point up or down, but this is the level that we see going forward in the near term. If there is a very significant shift in the environment, that may change, but that we are not seeing at this point in time. So we think that this is roughly the levels that we will be going forward.
All right. Okay. Thank you so much, Mr. Seshadri, for joining in today with the outlook going forward and what happened with Q2 as well. Hope to be speaking to you very soon again. That's the word coming in from South Indian Bank. For now, we'll take your leave on this edition of Trading Hour, but stay tuned. Halftime report is up next.